On Thursday, Crocs and Celsius, two of my largest positions, reported earnings. As soon as the earnings were out, both of those stocks moved in opposite direction, but by a lot. Celsius went up by over 20%, while Crocs was down by 30%. One of the worst days in the history of this company. Of course, I'm sure you're more interested in me talking about Crocs because I have been talking about it more, and it is a larger portion of my portfolio, today around 16%, my second largest position. If such a company is down 20%, 30%, we need to address it. But I could not talk about it on the same day because I did not really look at the fundamentals. I did not really look at the numbers. I look at the earnings, but to think about the fact that the market reacted just seconds after it happened, you can already be sure that this is not done by humans. It's algorithm. And were these algorithms right or wrong? This is what we're going to talk about today. Whether they were right or wrong, you need to understand that you should not be reacting to what these algorithms are doing. Because if it can react to an earning report just seconds after it has been released, it cannot be accurate. In the case of Celsius, the cash flow statement on the 10Q was not out until the next day. So how can the market already react to the earnings? It cannot be accurate. So this I can already tell you. Now let's talk about Crocs. There are two important things to note. First of all, there was an impairment of goodwill and other intangibles from the Dude acquisition because it is not generating that much cash flow, that much profits that they were anticipating. They have to do an impairment of goodwill. This is normal and probably the market was already expecting it. The other thing that happened was that the company said that next quarter, on the third quarter, revenues will be down by around 10%. And they are doing that because of economic uncertainties. With tariffs, with the economy in general in the United States, they have decided that revenues will be down by about 10%. I think they said 11 to 13%. It doesn't really matter. But what matters is why they took this decision. This is the company taking the decision that they are going to lower revenues. It's not that they cannot sell their products. They have decided not to invest that much in marketing and they are going to sell fewer products in order for them to preserve margins. They want to be a high margin company. Let me just give you a simple example. Let's say a company has $100 in sales revenues, 20% margins, which is quite good. So $20 of profits for every $100 of sales. Now, if they know this company that they, in order for them to grow, they will have to lower margins. So for them to make $110 the next year, they will have to lower margins to 15%. So the profits will be $16.50, which is not bad. It is worse than the $20, but still you can say that revenues has grown. But the fact that margins went down means that it is fewer profits. That's only part of the problem. The other part is that if a company decides that it's better to lower margins in order for them to increase sales, it means the market, by the market, I mean the consumers, they are going to look at the product in a different way. It's no longer considered a premium product. It's something that anyone with little money can go and buy. And then when the economy recovers, when the company can grow sales without sacrificing margins anymore, they cannot return to what they used to be because now consumers have already accepted that this is a cheap product and they will not want to pay higher premium prices for it. So once you do this, you cannot go back. It's better than for the company to preserve margins, a company like Crocs. And this is exactly what they are doing. In our simple example, that company that is making $100 on sales, now they cannot have 20% margins. They say, okay, let's lower sales by 10% to $90, but we are going to have only 18% margins. So they are preserving margins as much as they can while cutting on sales growth. In this case, the company is going to make $16.20 in profits. It looks worse compared to growing, but this is a long-term game. It's better to take the hit up front and then you know that you have preserved your margins when the economy recovers, when things become better, when the tariffs have normalized, they can still be a high margin business. Another important thing to understand about Crocs is that it is a capital light business. And it's not because they are sacrificing margins. You can be a capital light business if you delegate all the tasks of productions to another company, but then you have to pay them. You have to incur the cost of sales. But this is not the case with Crocs. They are very capital light and efficient company with high margins. So they can make a lot of profits on little revenues. I don't know how much cash flow the company will generate next quarter. It is going to be lower than the long-term average. That should not be an issue if the stocks are cheap and the company doesn't require capital to grow. And a company like Crocs, it doesn't require that much capital to grow. The capital expenditures of the company, I think, was only $75 million for a year. Most of the amortization costs was deferred taxes. There was impairment of goodwill, which are all non-cash expenses. So the cash flow generation of Crocs is still here, and the company can repurchase shares. Last quarter, they repurchased $103 million worth of shares. So at current stock price, if they do that again, that would be 3% of the shares outstanding. Over a year, let's say 10%. So if you can lower your number of shares outstanding 10% in a bad year, for me, that's a good thing. Because when a good year comes again, you own 10% more of the company as a shareholder. And the market, the way we have talked about this a few minutes ago, the way the market reacts, it's not about the fundamentals, it's just in big news. And when the market will see, okay, Crocs, just because number of shares are less, the earnings per share is much bigger than the market was anticipating. And probably the stock price will go up by 30%. I don't know. I don't care by how much it goes up, but it's just a long-term game and you need to accept that. I'm not sad that the stock price of Crocs went down. Of course, I would have preferred it went up, but I took the opportunity to buy more shares. I don't know how much more I will buy. There are other opportunities in the market and it's already a big position in my portfolio. But if I did not own that many shares, of course, I would have bought a lot. I don't think it is necessary to make another video about Celsius. So I would recommend you watch this video, which I already talked about the company, the Alani new acquisition and everything. Have a nice day and goodbye.